This is a lecture for Wednesday, 1st of December. Okay, now you are still in topic 6, financial statement analysis. Financial statement analysis is like this. This is just like to refresh your memory. Financial statement analysis is like this. Every year a business has to prepare financial statement, and then if you only see the financial statement, you can make a general conclusion only. For example, if you see the income statement, if the income statement shows that the business is making profit, then you can say that the business is performing well. That is the general conclusion that you can make. And then if you look at the balance sheet, if the amount of debts or liabilities is less than 50% of the total asset, then you can say that the financial condition of the business is good. That is the general conclusion that you can make. But you only can make a good conclusion after you analyze the financial statement. There are several methods that can be used to analyze the financial statement. For example, horizontal analysis, vertical analysis, and also financial ratio analysis. This topic 6 is focusing on only one method to analyze the financial statement, which is the financial ratio analysis. In the previous lecture, I have explained about the liquidity and efficiency ratio. Today I will explain about another group of ratios. It is called solvency ratios. So for this course, you will see debt ratio, equity ratio, and debt to equity ratio. These three ratios are related to solvency. Solvency means the simple definition for solvency is the ability of the business to survive, to continue its operation in the future. And it is related to the debts most of the time. Okay, so the first is debt ratio, and then the second is equity ratio. So the way to calculate debt ratio is total liabilities divided by total asset. So if you look at the sample financial sample income statement and balance sheet that you can see at the beginning of this slide, at the beginning of the slide for this topic 6, you will see that the total liabilities of the business is 248,028. So you divide this number with the total asset, which is the 338,516, and you will see that the total liabilities, the debt ratio is 73.3%. See the green box at the bottom of this slide. The debt ratio shows total liabilities as a percent of total asset. So that is the way to calculate the debt ratio. The way to interpret the debt ratio is like this. If the debt ratio is below 50% or below, then you can say that the financial condition of the business is good. If the debt ratio is more than 50%, then the general conclusion that the conclusion that we can make is the business is not in a good financial condition, because the amount of debt is more than 50% compared to the total asset. It shows that the business has too many debts, too many liabilities. Every month or every year, the business has to pay a lot for liabilities. So very difficult for the business to survive, to continue to survive in the future. It is like your if the way to understand it like this. Let's say it is you, for a person. Imagine if, let's say, your total asset is, let's say, $20,000. Make it simple, $20,000. You as a student, you have $20,000, but your debts is $15,000. Can you imagine? Very difficult to survive, because every month you have to pay your debts. But if your total assets is $20,000, but your debt is like $4,000, and then you can imagine, very easy for you to survive in the future. Easier. That is applies to businesses. If their debts is more than 50% of their asset, then you can imagine difficult for the business to survive in the future. The second ratio that is related to solvency ratio is equity ratio. The formula to calculate the equity ratio is total equity of a business divided by the total asset of the business. This ratio shows the total equity as a percent of total asset. So the way to interpret the equity ratio is like the opposite of the way we interpret the debt ratio, because you know the equation, the accounting equation, assets or equal to liabilities plus equity. So if the equity is low, the liabilities are high. So if the equity ratio of a business is low, so it shows that difficult for the business to survive in the future, because most of the assets are financed by debts. So like I said earlier, the interpretation for the equity ratio is the opposite of the interpretation for the debt ratio. And then there is another ratio related to solvency, which is debt to equity ratio. See here, the formula to calculate the debt to equity ratio is total liabilities divided by total equity. If we use the sample income statement and balance sheet that I have given in the slide, the calculation is 248,028 divided by 90,488, equal to, for this business, 2.74. See here the bottom, the box at the bottom, green box at the bottom, it says that this ratio measures what portion of a company's asset are contributed by creditors. A larger debt to equity ratio implies less opportunity for the business to expand through use of debt financing. So if the number is a big number, if the equity ratio, debt to equity ratio number is a big number, then it shows that the business already borrow a lot or has high liabilities. So in the future, difficult for the business to borrow more to finance its operation. That is the way to interpret the ratio. Okay, this is the third category of ratios. It is called profitability ratios. In general, these ratios measures how good the business in making profit. Okay, there are four ratios here under the profitability ratios. And there are many more actually, but these four is sufficient for this course, because for this course you are learning about how to prepare financial statement for sole proprietorship service business only. So if you learn about accounting for companies, the account are more complex. The financial statement also more complex. Then you have many more ratios that you can use to assess profitability, solvency, and also the liquidity. So, but for this course, several ratios is sufficient. Okay, let's see one by one. Gross margin ratio. Gross margin ratio is only can be used for a merchandising business. So for a service business, you cannot use this ratio. This is just like for your knowledge only, but you cannot use this ratio for a sole proprietorship service business. So gross margin ratio equal to net sales minus cost of goods sold divided by net sales. So only merchandising business and manufacturing business have sales account, because manufacturing businesses and merchandising businesses, they sell items or products or goods. A service business does not sell anything. A service business only provides services. So these ratios cannot be used for a service business. So see here the formula minus cost of goods sold. Cost of goods sold are a cost that the business has to pay when the business purchase product from supplier, or when the business makes products, if the business is a manufacturing business. So don't worry about this. So I just go to the next ratio, profit margin ratio. Okay, this ratio can be calculated for a sole proprietorship service business. The formula is net income over sales. For the sample income statement and balance sheet that we use in this topic 6, profit margin ratio equal to net income 55,256 divided by net sales 260,104 equal to 21.2%. Okay, remember this ratio measures a company's ability to earn net income from each dollar of sales. So see here, if the profit margin ratio equal to 21.2%, it shows that for every $1 of sales, this business can generate 21.2 cent profit. 21.2 cent net profit. So if there are two companies, one company is like this, the profit margin ratio is 21.2%. Another company, the profit margin ratio is 17%. So which business is better? This business or the other business? The answer is this business, because this business can generate profit for every $1 the business sells something. The profit that this business can get is 21.2%. Sorry, 21.2 cents. But for another business, the profit margin ratio is 17%. For every $1 the business sells something, the business only can generate 17 cent net profit. So that is the way to make comparison and to make conclusion. The higher the ratio, the better in terms of the higher the ratio, the better the business in terms of generating profit for every dollar of sale. Return on asset. Okay, return on asset is one of the profitability ratio. The way to calculate the return on total asset ratio is net income or net profit of the business divided by average total assets. Net income or net profit, you can get the number from income statement. Average total assets, you can get the number from the balance sheet of the business. So for the sample business that we have in this slide, if you want to calculate the return on total asset, the net income is equal to 55,256 divided by average total asset. So the way to calculate the average total asset is the ending total asset plus beginning total asset divided by 2. The ending total asset is the total asset at the end of the current accounting period. The beginning of the asset, the beginning balance of the asset is the ending balance of the previous year total asset. Okay, you have to find the average. So beginning ending balance plus beginning balance divided by 2, that is the average of the asset. So in this example, the return on total asset ratio equal to 15.7%. Okay, see the green box, the light green box here. Return on total asset measures how well assets are utilized by a business. The relation between profit margin, total asset turnover, and return on total asset is like the gray box at the bottom of this slide. But the one thing that you have to know, okay, return on total asset shows for every $1 of asset, how many profit the business can generate. If the number here is 15.7%, it shows that for this business, for every $1 of asset, the business can use the asset to generate 15.7 cent profit. So for this ratio, the higher the ratio, the better the business in terms of its ability to generate profit by using its asset. If you compare two companies, if you compare two companies, the company with higher return on total asset is better compared to the other company in terms of its ability to use its asset to generate profit. And then this is return on equity. Return on equity measures the ability of a business to generate profit for investors. Remember, equity amount of dollar owned by the owner of the business. So the return on equity ratio compare the net income or net profit with the average total equity of the business. So the higher the return on equity ratio, the higher the ability of the business to generate profit to the investor or to the owner of the business. In this example, the net income or net profit is 55,256. The average total equity is equal to, see here in the gray box, the average total equity is the ending balance of the equity plus the beginning balance of the equity divided by 2. So for this sample business, the return on equity equal to 55.9%. So it shows that for this business, for every $1 invested by the owner of the business can generate 55.9 profit. So this is a good business. If you invest $1, you will get 55.9 cent return at the end of the accounting year. Let's imagine you invested $10,000. Let's say you invested $10,000. The business will generate $5,590 for you. That is a good, very good return. So if you compare two companies, the company with higher return on equity is a company that can generate better profit for every dollar of investment. Okay. So this is the summary of ratios. The ratio with the formula to calculate the ratio and what the ratio measures. If you look at this summary, there are many ratios, but I have the ratios that I have explained, only ratios that relevant for you. Remember, you are learning about how to prepare accounting record or how to prepare financial statement for sole proprietorship service business only. So the number of ratios that you can use is small. There are many more ratios. And the other ratios are ratios that only can be used for merchandising business and manufacturing businesses only. But for your course, just focus on the ratios that I explained in this lecture for topic 6 only. Okay, that is the end of topic 6. Do not forget to write your name and matric number in the comment section. I will take that as your lecture attendance. Thank you very much.